Hey, Bowtie Nation, Joseph Hogue here with your weekly stock market update, now coming to you on Sunday at noon before the market starts with the stocks to watch and the stock market news you need to see. And Nation, tech stocks and the NASDAQ index have plunged 12% since their October peak. And even the old school names in the Dow are now in correction territory, down more than 10% from their highs. The crash is even worse in segments of growth stocks, with shares of the AI ETF, ticker AIQ, down 14%. Cybersecurity names in the CIBR fund down 22%, and fears of that AI apocalypse in software, forcing those stocks down 31% in just 5 months. Every stock market crash starts this way with clues to the market. I'm going to show you those clues, how long the sell off can continue, and how to invest, along with the 5 stocks I'm buying right now. Stick around and I'll also update you on shares of Alphabet, ticker GOOGL, a pair of housing stocks selling at 30 and 50% discounts to their fair value, and give you an update to our stock market outlook. First, onto that stock market correction though, because while the broad S&P 500 index seems to be holding up better, it has now fallen 5 consecutive weeks. It's the worst stretch since the market crash of 2022. The tech-heavy Nasdaq is now down 12% from its October peak, and the S&P 500, which peaked later in February, is now down 9%, just a percent from correction territory. Those AI-related names have gotten hit even harder, with those software stocks losing a third of their value, and everything down double digits. Now, I'm going to walk you through everything forcing this sell-off in stocks, how long it could last, and then what I'm buying to both protect my portfolio and be ready for the rebound. First off, though, understand that this is actually pretty normal. Going back more than 40 years, we tend to see a sell-off of at least 5 to 10% every year. Red dots in the chart here are the biggest drop for the year, and you see, most years investors get skittish at least once and head for the exits. Research by Goldman Sachs shows the average drop in 26 full-blown corrections since World War II, where we saw stocks drop at least 10%, but then less than that market crash of 20%. The average sell-off was just under 14% and lasted 4 months. Now, of course, that doesn't make it any easier seeing your portfolio drop right now to know that it happens every year, but it does give us a little more confidence that if the right levers are in place, it can pass quickly and the market can start heading higher again. And the reasons for this crash aren't simply Iran and those higher energy prices. Tech stocks in the NASDAQ have been falling since November, and software stocks have been crushed all this year. But Nation, the underlying fundamentals of this market are strong, with analysts forecasting 17% growth in profits for the S&P 500 companies this year, and as high as 20% in the third quarter. Earnings growth is the core foundation of stock prices. The company's earnings are what you own as an investor, and 20% growth is very rare. Now, along with hundreds of billions of dollars in tax savings from last year's budget bill, economic stimulus that would have boosted both households and corporations without that war in Iran, that previous stock sell-off would have been small and short-lived. But with Iran and higher oil prices, inflation could mean lower consumer spending, no more stock-supportive rate cuts by the Fed, and economic stagnation. So the only relevant question is, how long does the Iran war last, and how bad does it get? President Trump estimated initially a campaign of just 3 to 6 weeks and is pushing for negotiations now into the 4th week. But folks, just looking at this critically from someone that has been in the military and has studied geopolitics, this could go on for much longer, and you need to be ready as an investor. First off, the 5,000 troops currently deployed to the Persian Gulf are not nearly enough and just not the right type. I love my brother Marines, and the Army's 82nd Airborne is hardcore all day, but these are strike forces, not groups that can be used, nor is 5,000 nearly enough to occupy a target. The idea right now is that these troops could be used for a quick strike on either Karg Island, through which Iran passes 90% of its oil exports, or Keshem Island, which sits right on the choke point of the Strait of Hormuz and is where Iran is said to have a massive store of missiles and mines. Now, the problem with this, for example, Karg Island is less than half the size of Manhattan. Put a few thousand troops there, and they're going to be sitting ducks to any retaliatory missile attack. Not only would the US see casualties jump into the hundreds very quickly, but taking either of these islands would just be short-lived because we just don't have the logistics or the troop numbers ready for an occupation force. Now, reports are that the Pentagon is considering deploying another 10,000 troops to the area, which would support an occupation, but It would also increase the potential for casualties exponentially, so really doesn't help our options much. More telling, though, especially in the light of that analysis where the US has no viable options to force Iran into negotiating, is a look back to the 1979 hostage crisis. Back then, the Ayatollah overthrew the Shah and took 66 American hostages from the embassy in November. Now, that crisis could have been negotiated much sooner, but Iran held those hostages for 444 days just so it could humiliate President Carter, releasing the hostages the day Reagan was confirmed. Folks, the fact is, Iran is beaten but nowhere near busted, and it knows the longer it drags this on, the higher oil and gas prices go, the more pain Trump is going to feel in the midterms. Iran can't win outright, but they can easily hold out for a few more months or even the 7 months to November, and this is not yet reflected in the market. So now the truth is, there is no way of knowing how long the market crash could last. President Trump is very motivated to bring a quick end to it, but the Iranians have every incentive to drag it out. I'm going to highlight some of the price levels I'm buying in at, ways to buy this dip smartly next in our market outlook. But first, I want to highlight 5 stocks to watch that can protect your portfolio and have you ready for the rebound. First up here is Datadog, ticker DDOG, has been hit in that software sell-off, now down 43% from its November peak. But this one came up in my Wednesday video with the FinTech channel, and I really like the story here. I'm going to link to that video below. Make sure you check that out because we talked through 4 other stocks in the software sell-off, but Datadog is very similar to Palantir in that it enables corporate customers to use their data across enterprise, from software to security and operations. Datadog also charges on a usage-based model, so it's more protected from the AI apocalypse hitting software firms and those legacy seat-based revenue models. But where critics say Datadog falls short of Palantir is that it hasn't had the AI capabilities to put the company's data to work until now. The company in February signed a partnership with Sakana AI that's going to help drive models to implement AI services, so we could be looking at the next Palantir, but at a much better valuation. Now, again, we have no way of knowing how long the market is going to continue to sell off, but Iran is likely to stretch it as long as possible. And that means we do want some downside protection for these growth names against those near-term losses. For that, we can go to the options available for Datadog, and I'm going to use the October options here. That gives us protection through mid-October, which is probably the furthest market weakness is going to run. And what I would do here is a covered call strategy, where we buy the stock, but at the same time sell call options against our shares. Here we sell the $125 strike call option. We'll collect $16.95 in cash for that, basically collecting a 15% cash return immediately on our stock. That goes a long way to cushion any further sell-off and, in fact, lowers our cost for the stock from $114 per share down to just $97 each. So if the market continues to sell off and takes Datadog down with it, we won't start losing money until it's fallen past $97. Here's the great part though. If the stock does rally and runs past $125 per share by that October expiration, we're still going to have made a 28% return, and that's just in the 7 months to October. There are 29 other option strategies you can be using, including one that makes money whether a stock goes up or down, like the straddle strategy. But I understand that this can be confusing at first. To help you get started, I'm offering a 38% discount to our Ultimate Options course. Over 3 hours of video, I start with the basics, then walk you through 29 option strategies, when to use each, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy, and an options calculator to show you exactly what to expect. Nation, do not neglect options investing. These are your best tools, not just for reducing risk, like in that example, but also to help boost returns and create income. This course will pay for itself with that strategy finder, the options calculator, and a 14-day guarantee, so check out the link in the description or just scan the QR code here. I've also been buying the dip in shares of Broadcom, ticker AVGO, now down 27% from its December peak. Now, all you out there in the nation know Broadcom is the one stock I think can beat Nvidia in the AI arms race. CEO Tan highlighted his target for $100 billion in AI chip sales on the earnings call a few weeks ago. And the company helped develop Google's TPU chips that have seen its stock jump and expects to ship huge volumes in chips to both OpenAI and Anthropic over the next year. From just $20 billion in chip sales last year to a $100 billion milestone, that would be exponential growth. But here, since I do believe the Iran issue continues much longer than is expected, even now, and we could still see that sell off intensify, you need stocks in your portfolio that are going to help soften that and even drive it higher. Here, if we look at the sectors that have held up over the last month, it's been all oil and energy stocks with an 11% return. But utilities and the telecom names in the communication services sector have also done relatively well. I highlighted Chevron, ticker CVX, in our video last Tuesday, already up 7% since then and 13% over the last month. Chevron gives you an integrated oil stock with everything from oil exploration through refining and gas, so the entire industry, and with the advantage of size. Besides that upside return, you're also collecting a 3.3% annual dividend while you wait. Shares of Verizon, ticker VZ, haven't blown the doors off with a return of just 0.3% over the last month, but it is a safety stock paying a solid 5.6% dividend. And nobody is canceling their cell service because of a recession, so this is going to be one to hide out in. And while shares of NextEra Energy, ticker NEE, are down 2.5% over the month, it's also relatively safe and pays a 2.7% dividend. People need their electricity no matter how bad things get, and NextEra has the benefit of its nuclear generation, which is going to be a big driver of earnings over the next few years. Looking at the stocks I'm watching this week, ARM Holdings, ticker ARM, bucked the trend with shares up 9% last week and as much as 20% on a single day when the company unveiled its AGI CPU chip, from which the CEO said ARM could generate an additional $15 billion in annual sales by 2031. This transition from just licensing chip architecture to producing a chip internally puts it in direct competition with AMD and Intel, but had analysts upgrading their targets, with HSBC saying the company could have another 50% upside. The average analyst target of $174 per share is still about 20% higher, with the high target at $240 each. Our shares have run 150% from the IPO in 2024, but been mostly range-bound for most of that time and could be a good breakout opportunity. Home rental stocks have been slammed as politicians talk up restrictions on institutional buyers of housing, but a giant discount is building here. Shares of American Homes for Rent, ticker AMH, are down 27% over the last year, just under the 28% plunge on competitor Invitation Homes, ticker INVH. Now, I am preparing a full video with deeper analysis here, but the upside comes to some fairly simple math on these. American Homes for Rent trades for a market cap, so that's the total market value of $11.6 billion against its 60,337 rental properties owned across the U.S. Now, that implies a market value of just $192,200 for each of these houses. And that price is even lower at a $15 billion market cap for Invitation Homes on its 86,000 properties, or a value of just $174,000 each. That is a sizable discount if you consider the median home price of $405,000 across the country. And if you look through these portfolios, most of these houses are located in solid middle-income neighborhoods. Both companies are transitioning to a build-to-rent model, so away from that buying existing homes that has inflamed the critics. Both have solid balance sheets and pay a dividend over 4% while you wait here, so now there is more analysis needed, but these are becoming too cheap to ignore. And Alphabet, ticker GOOGL, hasn't escaped the sell-off, with shares down 12% this year and into a bear market of 21% from last year's peak. Investors may be missing out, though, on one of the best deals in the market, with a good value on its core business, and a lottery ticket upside from the Waymo unit. The company unveiled a major breakthrough last week, a new compression method called TurboQuant that could reduce the amount of memory required to run AI models by as much as 6 times. Now, considering that memory shortage is the big AI bottleneck right now, could mean a very strong competitive advantage for the company. Alphabet is expected to grow sales by almost 17% this year to $470 billion and to produce $11.43 in per-share earnings. That puts the shares at a price-to-sales ratio of just 7 times this year's revenue and 24 times on a price-to-earnings valuation. Now, that's not can't-ignore levels of value, but there is one segment here that could make this a steal. The Waymo robotaxi unit is dominating its industry with over 170 million rider-only miles already, with and with a track record of 1/10 the risk of serious accidents compared to a human driver. Analysts estimate the company reached annual revenue of $350 million this year, almost 3 times the 2024 number, and it's expanding into 15 more cities this year. The last funding round valued Waymo at $126 billion, but this could easily be a trillion-dollar plus company when it eventually is spun off from Alphabet and issues its own shares. It may take a few years, but that is going to significantly increase the value of shares for Alphabet, and it's not going to be all at once. Take advantage of the discount now to start building your position. Now, updating our near term market outlook, we see the important monthly jobs report here on Friday, and if it's anything like the surprisingly bad loss of 92,000 jobs we saw last month, it's going to put a rate cut back on the table for this year. Right now, the market is expecting 45,000 jobs to have been added last month. That would be a hell of a lot better than last month, but is still a strong signal of a weak jobs market. But then perversely, a weaker jobs number wouldn't be altogether bad for stocks because it would point to a Fed back in rate cutting mode. With inflation jumping past 3% in the recent CPI report, the market is now expecting the Fed to stay on hold for as long as September of next year and possibly to even increase rates. Now remember, the Fed has just 2 rules: to keep inflation low, but to also support the jobs market. Now, with those conflicting signals, high inflation but a weak jobs market, I believe it's going to choose to err on the side of cutting rates and protecting those jobs, even if inflation stays high. But then even hopes for more rate cuts likely aren't going to save this market over the next few weeks. Now, I warned 2 weeks ago that the market was heading for a correction, with the Nasdaq and the Dow indexes now passing that level 10% from their peak. A 10% correction on the S&P 500 would be at 6,300, which we're likely to see at least this week or next. Without a major development on Iran, I'm watching for 5950 on the S&P 500 index. That would be a 15% from its peak and a good time to start aggressively buying this dip. Now, that might not be the absolute low, but with analysts still expecting the 500 companies in that index to report $319 in cumulative earnings this year, that 5950 level on the S&P 500 puts it at just 18.6 times on a price to earnings valuation. Now, that is well below the recent 5-year and 10-year average PE value for the index, so a good value to pick up stocks. Get your $150 discount and get started investing in options with the link below in the description. Everything you need to increase returns and reduce risk, all with a 14-day guarantee. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.